In the last class, we learned about equal highs and equal lows liquidity and their entry models. What is going to be very challenging for you while trading this type of liquidity concepts is something we call about inducement. So in today's class, I'm going to define what is inducements and how we are going to avoid it in order for us to win more trades and lose less and less and less of our trades. Okay? So with an illustration, let us say that we are in an uptrend. Let us define what is inducement. Let's say, for example, we are in a trade and this is an uptrend. So we are expecting some buy trades. Okay. So we form this higher high here. Okay. After forming this higher high, the price will retrace a bit. Okay. To form this first shoulder here, the price will retrace a bit to form a head pattern. We will experience something we call a BOS. A BOS is a break of structure, and this structure forming a higher high compared to this first higher high. Okay, the price will come back then to retest this shoulder. Okay, form uh, form this angle. Okay, and what we expect is that the price will retrace back to this neckline. Okay, before either moving up. That is our expectation. Okay, but this most of the time is the trap. This is what now is called inducement. Okay, inducements or the trap. Okay, most of the time the price will come, take those people who had placed their stop loss along these lows and then move to the original direction, which was an uptrend. So in this case, the price will come lower, take these people's stop losses, and then move up to the desired direction, the original direction, which was an uptrend. So in this case, we are having this level. Okay, we are having this level and it is a zone. Okay, we are having this level as a zone, and this zone in this case we will refer it as a demand zone. Okay, so we refer it as a demand zone, and this demand zone in our case right now is a POI. What is a POI? It is a point of interest. So the smart money traders are going to wait for the price to reach these areas before they can enter their buy into an uptrend. Okay, but the novice traders will have taken their buys here, they put their stop losses here. We use their stop losses as liquidity for us to enter our trades here and target these higher highs. All right, so basically this is the simplest concept of inducement. This is where the inducement has happened, and basically it is called a trap. Okay, so liquidity zones act as liquidity traps where large players manipulate the market to create a false sense of trend direction. Okay, so you see, they engineer a move that attracts retail traders to enter at very unfavorable levels, like these levels. These are very unfavorable levels. Okay, so this causes their stop losses, like what we have seen here. This causes their stop levels to be triggered before now the price moves to the original desired direction, which was what? Which was an uptrend. And this is the summary of the smart money concepts. All right. So, how exactly do you define a true zone, which is a demand zone, a point of interest, from an inducement zone? Okay. Well, this comes to two main big things. First of all, it it really depends on this concept called liquidity. Okay, remember that this is a class that we had captured on its own, a lesson that we had discussed, liquidity. Remember, we had also talked about imbalance as a topic on its own. Okay, imbalance. So the concepts of inducement, how to know whether you have a true zone or an inducement zone, really depends on these two concepts. The liquidity, where is the liquidity, and where there is an imbalance. All right, good. So there are three different types of inducements. There are three different types of inducements. Type number one is what we'll call supply and demand inducement. Okay, so there are three types of inducement. The first inducement is what we'll call supply and demand inducement. Number two is what we'll call support and resistance inducement. And lastly, it is something we call consolidation inducement. Okay, so if you understand these three types of inducements, you are qualified to know where these levels occur, avoid them, and go to the point of interest, which are the true demand zones and the true supply zones. Okay, so we are going to discuss one by one what is a supply and demand zone inducement, what is a support and resistance inducement, and what is consolidation inducement. Okay, so if you are done copying this, we will wrap and start looking at supply and demand inducement. Okay, so when we say supply and demand inducement, supply inducement happens on a downtrend while demand inducement happens on a downtrend. So at number one, we are talking about we are talking about demand. Okay, demand inducement, IDM. And here we are talking about supply, IDM. We have said that demand inducement happens in an uptrend. Supply inducement, we expect it to happen in a downtrend. Okay, so with illustrations, we are going to look at this type of inducements. We will start with the demand inducement. So demand inducement is expected to happen in an uptrend. Okay, so let us say that the market was in an uptrend, moving, creating higher highs and higher lows. Okay, so we expect the markets to come to that bargain price. Okay, move on to create a higher high. So this is the first higher high, this is the second higher high. Okay, after doing what? After creating a BOS here, a break of structure, creating a higher high. So in this case, we would expect that the price to come around this price. Okay, to come around this price, bounce off this area, because now this one is our expected what? This one is our expected demand zone. Okay, So this one is our expected demand zone. Okay, so we expect the price to come bounce off this demand zone, go creating higher highs and higher lows. Okay, but because we are saying and looking at the demand inducements, the price does not do that. The price comes down below that demand area, takes out liquidity for those traders who had placed their entries here, okay, and their stop losses there. They come take out all these stop losses and then moves to our desired direction. Okay, so our stop losses have been taken. This is now what we call what? A demand inducement. The exact opposite is true when we want to look at the supply inducement. It happens in a downtrend. Remember, in this case, the price was in a downtrend. Okay, it reverses to around that area. Okay, goes down. This is a lower low, goes down to create another lower low. So we expect if the price will come at around this area, because now this area is our supply area. Okay, this area is our supply area. Remember, here we have done what? We have created a break of structure. So we expect the price to bounce off this level and continue forming lower lows and lower highs. Okay, instead, to form a supply inducement, the market will come take all this liquidity and then go down, forming lower lows and lower highs. So remember, those people who had put their entries here and their stop losses above the supply zone have been taken out using this wick or a candle, and we are now creating lower lows and lower highs. Okay, and we are in a downtrend. So here we are in an uptrend, and here we are in a downtrend. Okay, so this type of inducement happens when the prices reverses from key demand zones and from key supply zones. Okay, but instead of reversing, the price breaks through this demand zone and this supply zone, as you can see. Okay, taking out these stop losses of traders who had entered into previous positions on these demand areas. Okay, good. So as soon as this happens, the price reverses and continue moving on the original move. Okay, good. So in a bullish trend, as we can see from this demand zone, for instance, the expectation is that once the price gets to this demand zone, the market will reverse and continue with this bullish run. Okay, the inverse is true. In a bearish trend where we have this supply inducements, okay, you would expect that the price to retrace at this previous supply zone before reversing down. Okay, our stop losses ideally are placed above the supply zone and below the demand zone. Okay, but instead of the price playing out, the price now gets to our zone, it tears through this our zone, taking these stop losses and then reversing to the direction that it was initially predicted. Remember, this is an uptrend and this is our downtrend. Okay, so in simple terms, this is support and demand inducements. All right, so this is the first type of inducement. The second type of inducement is support and resistance inducement. So with similar illustrations, we are going to look at support and resistance inducements. Okay, how it happens and how we can take advantage of it so that we can minimize our losing positions and maximize our winning positions. Okay, so secondly, we will be looking at support inducement and resistance IDM for inducement. Okay, so support inducement happens and resistance inducement happens. Okay, so this all of this happens when price reaches and approaches either a support area or a resistance area. Okay, so in this case, if you have a support area, we are saying that the price maybe is in an uptrend. The price comes back, forms this consolidation here. Okay, it comes, takes out this liquidity, okay, and continue going to its desired direction. So this area, and this area, if you join them with a line, what do they form? They form a support area, okay, or a support level. So there's a break of structure here. Why? To take out the liquidity of those buyers who had taken some premature buys here and they had placed their stop losses around there. So all of these stop losses have been taken out. Okay, they have been taken out, forming our inducement level and the liquidity. So in this case, this level forms our new demand. Okay, this forms our new demand. Okay, the exact opposite is true for the resistance levels. Let's say we were in a downtrend. Okay, the trade is moving like that, comes here, forms a consolidation. Okay, and the price comes here, takes all these stop losses that were placed around here. Okay, takes all that liquidity and we go down on a downtrend. Okay, so this one is called a resistance area or level. Okay, remember we are having some sellers here, sellers there, and definitely the smart money concepts are selling from this place to this place. This one creating a supply area or supply level. Okay, so support and resistance is our second type of inducement. Okay, so when price approaches or reaches this support, you expect it to reverse from there. You expect again to reverse from there. So there will be traders who will be taking some premature buying positions from these areas. Okay. On the other hand, when price approaches these resistance levels here, you expect the price to go down from this area, and from that area. Okay. However, instead of this playing out, okay, this forms areas of inducement. Okay, they induce the retail traders here. Okay, while the smart money takes out their stop losses and goes to the original move. Here they induce retail traders here into premature buying positions. They take out their stop losses and goes on with their original move. Okay, such they get cleared before the price reverses to the opposite direction. Okay, so most traders will call this false breakouts. Okay, most traders will call this false breakouts. Okay, These false breakouts, another name for false breakout is spring. All right, they are called springs. But in this case, they are inducement levels which are opting to take liquidity below here before going to the desired direction. Okay, good. So, onto the last type of inducement, we said these are consolidation. These are consolidation inducements. Okay, good. So we will wrap this and look at the consolidation inducement. This is the support inducement. Let us go and look at the consolidation inducement. So the third type of inducement is what we call the consolidation. The consolidation inducement. Okay, so these are formed when the support and the resistance are in a range. So just to illustrate, let's say we have our price coming from this area and it is forming some equal highs and equal lows. So in our case, this will be our resistance level. Okay, and this one will be our support level. Okay, the price moves and causes a break of this structure, goes higher, comes back into that range, breaks out this structure again, goes low, taking all this liquidity, comes back into that structure, and then gets a bearish move to the downside. Okay, so in this case, there are a lot of things that are happening. First, we are having this liquidity sweep here, liquidity sweep. Again, we are having a liquidity sweep here. Okay, good. So this consolidation inducement happens here. Here we have our first IDM. This is our first inducement. And here we are having our second inducement. So here we are having two types of inducement. One that is happening on the break of the resistance level, and the second one on the break of the support level. This is the first liquidity sweep, and this one is the second liquidity sweep. The price comes in this range and breaks again this support level, and it proceeds on a downtrend. Okay, so you see, a typical trader will trade this by buying this support. Okay, a typical trader will trade this by buying these supports like this and like this. They will place their stop losses here. Okay, they will place their stop losses there, and with this liquidity sweep, all of them are taken out, meaning that this one was an inducement level. Okay, and again, another typical trader will be selling at these points. Okay, they will be placing their stop losses at these levels and at these levels. Okay, with this liquidity sweep, meaning their stop losses were being taken out before the market comes into this internal price structure before moving on a downtrend. Okay, however, these support and resistance levels can be used as inducement areas. Okay, so that is why you see the price breaking out to clear the liquidity on either side of this range. Okay, so some of the traders, you'll hear them calling this as external to external inducement. Okay, you'll hear some traders calling this external to external IDM inducement. Okay, or you may hear some other traders calling this the power of three. Three meaning the AMD. Remember the AMD? We said that the AMD is accumulation, accumulation, manipulation, and distribution. Okay, distribution. So in our case here, from this level up to this level, this is what we call the accumulation zone. Okay, good. This from this level to this level, this is what we call the manipulation. This is where the manipulation happens. Okay, and from this zone to this zone, this is what we call the distribution. Okay, so this is the power of three, the power of accumulation, manipulation, and then distribution. Okay, so ideally, by looking at the three types of inducement, that was the supply and demand zone consolidate inducement, the support and the resistance inducement, and looking at now the consolidation inducement, we are correctly able to identify the inducement levels in the market, avoid them, and trade them where we have clear, true supply and demand zones. Okay, but the burning question in this lesson is, how can you correctly identify an inducement on a live chart? Okay, remember, spotting an inducement in a live chart can be very, very tricky. Okay, sometimes you do not know until the price action has finished, the inducement has already played. By then it's likely to be too late and your stop loss has been taken out. Okay, so to correctly identify these levels of inducement, we are going to look at five ways of correctly identifying your inducements in the charts. So if you are done with this, we are going to wrap that and look at the 5 ways that can help us to identify the inducement levels in the market. Okay, so the first way to identify our inducement levels is to look at the liquidity, to spot the liquidity areas. Okay, so the first the first ways is first to spot where the liquidity is. Okay, to spot where the liquidity level is. Secondly, is to observe the order flow of the market. Okay, third is the first rule of pullback rule. Okay, fourth is we will be looking for premature reversals in the market. Okay, and fifth, we are going to look at the extreme volatility zones. Okay, so to spot liquidity, you see, inducement levels coincide with areas of liquidity where many traders have placed orders. Okay, so if you can spot liquidity pools in the market, then you can spot inducement. Okay, so what we're saying is that inducement inducement IDM plus liquidity levels, this one goes hand in hand. Okay, where you spot the liquidity level, just know that the inducement levels are there. Okay, so usually the price takes out the liquidity, including the inducement levels, and trades into deeper supply and demand zones before reversing into your directions. Okay, so we had already looked at this example. Let's say the price was coming from that angle, comes here, forms kind of a shoulder, forms that head, comes back, forms that shoulder, comes back. So remember this, we said this was our trap, or this is what we call the inducement level. Okay, so we said that the price will come here, takes out this liquidity here. Okay, we come to our demand zone there. Okay, so that the price may do what? May reverse from that angle. Okay, so this is why your demand and supply zone does not form the liquidity before, then it might be a demand and inducement zone. Okay, if your demand zone or supply zone does not form these inducements, just know that that demand or supply zone that you are using may be an inducement. Okay, good. So the second way to identify potential inducement level in the market is what we call the order flow. Okay, you may look at the order flow. What is an order flow? Observing the order flow on a higher time frame will help you to identify inducement levels. Okay, so the order flow, there are two order flows in the market. The market can either be bullish or the market can be bearish. Okay, good. So if the market is bearish, then the chances are that any bullish move on a smaller time frame could be an inducement. Okay, so in any case that the market is bullish, and then on a smaller time frame, you have something a bearish, you have some bearish structure, just know that that one is an inducement. Okay, the opposite is true. When you are having bearish order flow on a higher time frame, okay, on a higher time frame, when you come to the smaller time frame, let us say that this one was our 4 hours. When you come to the 15 minutes time frame, you get some bullish price structure. Just know that that one is a what? That one is an inducement. It is as simple as that. Managing to know your order flow from the higher time frame and coming to look at the order flow of the lower time frame. If the two does not match, just know that the order flow that is forming contrary to the larger time frame, that could be inducement. Okay, good. So we are going to look at the third way to identify our inducement level, and that is the first rule of pullback, first pullback rule. Okay, so let us grab this and look at the third the third way to identify so the third is the first pullback rule. Okay, remember our price structure that is has formed a higher high there. It comes back to this level. Okay, this is now the first pullback. Okay, to that level. If the price, so this one forms a demand This one now forms a demand zone at first. So if the price does this and comes here, we if now this one is the first pullback. This one is the first pull back to the demand zone. Okay. So according to the first pullback rule, uh, we are seeing if you have a break of structure, remember, for us to form this one, we must have a BOS here, okay? Or a breakout. This can be either a break of structure or a breakout from either the support, from either a support zone, okay? So you may have a potential reversal, okay, from this area, okay, before price continue to do what? To move higher and higher and higher. But in many cases, these zones that we refer as demand zones are not likely to be respected by this price to go higher. They are more likely to be used as inducement zones, the IDMs. Okay, so the price may want to come, sweep the liquidity deeper into this zone, create a new demand zone after eating all these stop losses that were here, and then goes to our original direction and reaches the TP. Okay, so this is the third rule and the third way to identify potential inducement level. So we have found that the inducement level appears there. Okay. The fourth way to identify inducement is whether we have premature or mature reversals. Okay. So the fourth rule is to look out for premature and mature reversals. Okay, remember in the market we have points of reversals. Okay, when the market is efficient. So the fourth reason is premature reversals. Okay, good. So if you find that a market is making a turn at a level that has no significant backing, such as an order block or a breaker block, chances are that that supply or demand zone on that reversal leg is an inducement level. Okay, so we have mature reversals at at either at an order block or at a at a breakup block. Okay, so when this is not the case and you have premature reversals on a supply or a demand zone, just know that that supply or demand zone could be an inducement level, so you must watch out for that. Okay, the fifth and the last way to identify inducement level are the extreme. When you have extreme volatility zones, you are likely to see some inducement levels. Okay, you see, supply and demand zones formed during an extreme volatile price movement are likely to be inducement. Okay, this is because price has moved with so much volatility that the market is no longer efficient. Okay, so these zones, you must approach them with a lot of caution. Okay, we have just looked at the 5 ways to identify inducements in the markets. We have looked at 3 types of inducement, that was supply and demand inducement. We have looked at support and resistance inducement, and lastly we looked at consolidation inducements. We have seen how liquidity and imbalance plays out in the formation of these inducement levels. Okay, so by that we have reached the end of our inducement class today. Okay, so if you are watching this class from YouTube, consider to like, share and subscribe to this channel so that you may get notified on our next class.